like everything you're learning about through these SAM School videos, you really need to be a student of the industry. There's CFP programs that are 2 years long. One of my majors in college was finance, and I can spend an entire semester, 3 days a week with the professor, hour and a half each class, and he can fill up a whole semester worth of talking about stocks and bonds and mutual funds and investment products. There is a lot of material that you really need to get very comfortable with before you can really be proficient in this industry. These SAM School videos are not nearly going to be enough for you to really understand all the ins and outs of all these different products. This topic for this segment is of course going to be mutual funds. There is a lot of information on the internet about mutual funds. A great resource is Morningstar.com. We have investment analysts in our office who have access to Morningstar Office Workstation, Morningstar Advisor Workstation, and you can get reports for any mutual fund in the world. And on those reports will be all sorts of different data. You'll see things like alpha and beta and R-squared, variance, standard deviation, best and worst time periods, holdings, turnover. There's so many different types of data points. I'm not going to spend this segment talking about every single data point or every single type of statistic that you can look at to analyze mutual funds. This segment is about giving you a big picture understanding of what mutual funds are, how they work, and some of the key things we look at as financial advisors when determining if a particular fund is suitable for a client. So again, big picture understanding. It's really your job as an advisor to become well versed in what all these different mutual fund statistics are. I don't want you to be well versed because you want to regurgitate all that information to a client and share all this big picture, smart, fancy stuff to a client. I want you to understand it so you know what you're doing, but in the sales portion of SAM School, I'm going to tell you how to explain this stuff to clients. So really, study the industry. There's all sorts of videos on Google and YouTube and Investopedia, Morningstar. Use the resources around you to become an expert in your field, especially when it comes to mutual funds, because you're going to use them a lot in the Liberty One models and other 529 platforms and whatnot. But for now, I'm going to share with you some basic mutual fund principles and some basic mutual fund data points and statistics. A mutual fund is a great way for a client to gain instant diversification. So what I mean by that is, let's say, just for sake of an example, you've got a client that has $5,000 to invest. Now I know that's a low number. You're not going to make a living picking up a bunch of $5,000 clients, but I'm sharing this with you for sake of an illustration. That client comes to you and says, I want to invest in stocks. Well, if they've got $5,000, you can really only divide that up maybe into 4 or 5 different stocks, because you're going to want to invest maybe $1,000 in 5 different stocks, and that's not a very diversified portfolio. What a mutual fund does is a mutual fund pools money from thousands and sometimes millions of investors, puts all that pooled money in a bucket, and inside that bucket buys all sorts, dozens, sometimes hundreds of different stocks and bonds. And by owning a share of that mutual fund, you own little shares of all those other holdings, stocks and bonds that are inside that fund. So for example, my initials are BWP. I'm going to add another P, and I'm going to add an X. Because all mutual fund ticker symbols have 5 letters, and they always end with an X. ETFs and stocks also have ticker symbols. Sometimes they can be 5 letters. but they'll never end with an X. So whenever you see a ticker symbol that ends with an X, you know you're looking at a mutual fund ticker. Okay? So let's say, for example, that this is the BWP fund, BWP Mutual Fund, and that's the ticker. Well, there's all sorts of investors. Some investors will invest $5,000 into this fund. Some might invest $1,000. Some will invest $100,000. And some could even invest $1 million plus into that fund. So all these investors from all different areas in the world are putting money into my fund. Let's say I'm the fund manager, and let's say that I am running this fund as a large cap value mutual fund. That means that by prospectus, me as a fund manager need to buy and sell large cap stocks inside this fund. If I was a small cap company, I'd buy small cap stocks. If I was a large cap international fund, I'd buy large cap international. How the mutual fund manager manages the underlying holdings depends on what type of mutual fund it is, what the goal is. If it's a balanced fund, you'll have a balance of stocks, bonds, cash. Balanced international, you get the idea. Real estate fund, a lot of real estate stocks. Utilities fund, a lot of utility stocks. In this case, large cap value. So all these different investors are putting money in this fund because they want exposure to large cap value stocks. Inside this fund, I'm going to use this money to buy dozens and sometimes hundreds of different large cap value holdings. So what's nice is this $1,000 investor, when they buy a share of this fund, and let's say the share price is $40, that's referred to as the NAV, the net asset value. Net asset value is the term used to refer to a mutual fund's share price. So when this $1,000 gets invested in this fund, they're going to get X amount of shares of that particular fund. And by owning a share of this fund, they really have exposure to tiny little slices of all the underlying holdings. So every single day, all the holdings, or I shouldn't say every single day the market is open, every trading day, all these underlying stocks are increasing and decreasing in value depending on how the stocks are performing. So some of these stocks go up, some of these stocks go down. When it's all said and done, all the ups and downs are netted out to see what the gain was overall. That's why it's called net asset value, because you're netting out the ups and downs of all the underlying holdings. Every day you strike that price, and that's what accounts for the fluctuation of the net asset value of that fund. If someone's investing $1 million, then they're getting more shares, but they're going to receive the same relative performance, the same percentage, day over day or month over month or year over year, the same relative performance as the $1,000 investor. So if you're this person here with $1 million, rather than trying to pick and choose your own stocks, you can put the $1 million into one fund, make one purchase, and instantly have all your money diversified to all these different underlying holdings. And if I'm the fund manager, the client benefits from the manager's expertise, from his analyst team, that this team's job is to pick and choose the best large cap holdings and buy certain percentages of these based on which ones they feel are really good, which ones might be maybe not so good but still have some potential. They might have 10% of this holding and 1% in here and 2% in here. They're going to manage this however they deem appropriate, and the clients benefit from that management and that instant diversification. Now, in reality, what ends up happening in practice is you're going to create portfolios for clients made up of many different mutual funds. So, for example, you're going to have a pie chart, and let's say that you divide that pie chart into 5 different mutual funds. One of these slivers might be BWPPX, the mutual fund I just talked about. This, as we just talked about, is large cap value. This sliver might be international, this might be small cap, this might be mid cap, this might be bonds. So you're going to structure a portfolio with different amounts in different types of proportions based on what the client's objectives are, based on what their risk tolerances are. You're going to learn about Liberty One very soon. Liberty One is our internal investment management platform that has stocks, bonds, mutual funds, different investment models, really different pie charts that are pre-structured for you to use with clients. But fundamentally, many of the models in our platform are going to be different segments, different allocations of different mutual funds based on a wide range of different data. So again, mutual funds are instant diversification into different types of asset classes depending on what you're trying to accomplish with that particular fund. What I want to do now is get into some key statistics that you're going to want to take a close look at when analyzing different funds. There's something called quartile rankings. It's a Morningstar ranking that Morningstar, of course, gives to different mutual funds. I just got done with the example of large cap value mutual funds. There are hundreds of large cap value mutual funds out there in the universe. If you think of a quartile, you're dividing a quartile into 4 parts. You've got the top 25%, and then of course you've got the bottom 25%. Let's say that there are 500 different large cap value mutual funds out there in the universe to choose from. And you're looking at a particular mutual fund and you see that it was up 10% per year on average for the last 3 years. You don't really know if that's good or bad for that particular type of investment, large cap value, unless you know what other large cap value mutual funds did. What quartile rankings do is they take all the different funds in a particular type of mutual fund class, lump them together, and rank them based on risk-adjusted return. We'll talk about that a little bit more in a second. So if you have a fund that was up 10% last year, great return, but large cap value as a whole was up on average 20%, well then 10% doesn't look so good. So that particular fund would very likely rank in the bottom quartile. If large cap value on average was up 20%, but you have a particular fund that was up 22%, well then it probably ranks in the top 25. So Morningstar is a fantastic resource because it lumps mutual fund data from all over the world into one place and gives you the ability to benchmark a particular fund against other funds in its universe. That universe of similar funds is often referred to as the peer group. It's your mutual fund's peer group. So utility funds benchmarked against other utility funds, that's referred to as the utility fund peer group. So quartile rankings are very important. There's some other data points that I want to talk to you about. One of the first things that I look at when I'm looking at a mutual fund is I want to know how that fund is allocated. Let's say I'm looking at a balanced mutual fund. I want to go to Morningstar and look at the holdings. Look at the composition of that fund. Balanced always means there's usually a combination of stocks, bonds, and cash. Balanced. But balance for one company has different proportions than balanced in another. For example, you might have a balanced fund that's 20% bonds, 30% international stock that is, 40% US stock, and 10% cash. Where another balanced fund might not have any international, might have 70% US, or might have 40% in bonds and 60% US stock. Balanced is a very generic term that can mean a wide variety of things. So the first thing I like to do is zero in on exactly what the big picture breakdown of a particular fund is. If I'm looking for international balance versus domestic, I'm going to choose different types of funds for different reasons. So really zero in on the holdings. Once I get a good feel for what the holdings are, then I like taking a look at what the returns were, especially the returns against the quartile rankings, and then I'm going to take a look at different risk parameters, different risk measures. There's different ways to look at risk. There's two main risk parameters that you're going to look at a lot. Beta and standard deviation. And again, you can go to Investopedia.com, you can just Google beta or Google standard deviation, and you're going to get all sorts of good videos and good reading material that'll really dive into these details. But in general, I'm going to explain beta and standard deviation in this manner. Beta is a measure of risk. It's a measure of sensitivity against a benchmark. Standard deviation is a measure of volatility, but you're measuring against yourself. And I'll explain that more in a second. Beta is against a benchmark. Standard deviation is a measurement against yourself. So for example, let's say that your benchmark is the S&P 500, the Standard & Poor's 500 index. Let's say that you've got the S&P doing this over the course of time. That's your benchmark. But the mutual fund you're in does this. Notice how both lines trend upward, but the sway of the investment is much less than the jagged up and down of the S&P. This particular example, the investment would have a beta of, let's say, 0.7 on the beta scale. A 0.7 beta just means that the mutual fund in general has about 70% the sensitivity of the overall market. So with that said, when the benchmark is up 10%, on average, historically speaking, this portfolio is up about 7%, about 70% beta. When the market is down 10% on average, this portfolio or this mutual fund is down 7%, has 70% the volatility. You'll see betas in the low 0.2s. You'll even see betas higher than 1. So if something has a beta of 1.2, that means it's 120% more sensitive than the benchmark. So if the benchmark is up 10%, on average a 1.2 beta fund will be up 12%. It'll be up more, but it'll also be down more when things go down. So an investment that has a smoother ride still has reaction with the downturns and upturns, but not as fast, is going to have a slower or a lower beta. Whereas if you had a fund that went up more and down more and then up more, that would have a higher beta because it's more sensitive. Beta is just one of those things that you're rarely going to talk about with a client. I've got plenty of analytical clients who love talking about beta, so you need to understand beta and how it works. But you're not going to explain it to the average client because it's going to be information overload. But you need to know about it. We talk about beta a lot in our investment committee meetings, and you're going to run into it a lot when talking to mutual fund wholesalers. You can see how you need to have a benchmark in order to have a beta statistic. You do not need a benchmark in order to have standard deviation. Like I said before, standard deviation is simply a measurement against yourself, or against the fund itself, I should say. Deviation, of course, is a fancy way of talking about volatility, how much something deviates over a period of time. The more volatility, the more the range of up and down a mutual fund can have, the higher the standard deviation. Mathematically speaking, and you'll probably never need to remember this, standard deviation is the average distance of variables from their average. So for example, if you've got an investment that went up perfectly straight, so every single year it goes up by 5%, etc. The standard deviation is 0 because the return never deviates. It never changes. If you averaged all of these out, the average would be 5, and the average distance of all these returns from their average is 0. Therefore, standard deviation is 0. It's the average distance of all of these numbers from their average. So to put that in perspective with a more extreme example, let's say that you've got an investment that went up really big, went down, went up, went down, went up. So let's say in year 1 it was up 10%. In year 2 it was down 15%. In year 3 it was up 30%. It was down 20%, and then here it was up 35%. I know this is a lot of math, but that's part of just being in this industry, is understanding how these different statistics work. First thing I need to do, if I want to figure out the standard deviation, is I need to average all these returns. So 10 minus 15 plus 30 minus 20 plus 35, this nets out to a 40 total, and I have to divide that by the number of returns. You divide it by 5, of course, to get the average. So the average is 8. That's not the standard deviation, that's the average. Standard deviation is the average of the distance of all these relative to the average. So if this is 10%, that means 8% is right there. Well, 10% is 2% away from 8. So the first data point is 2. Negative 15 is 23% away from positive 8. So the second data point is negative 23%. 30% is 22% away from 8. Negative 20 is 28% away from 8. And positive 35 is 27% away from 8. Now, it's important to know that pluses and minuses don't matter when you're trying to figure out average deviation. All you want to know is the distance you are from the average with all these points. Now all you need to do is average the average distance, and that's how you get to your standard deviation. So 2 plus 23 plus 22 plus 28 plus 27, and of course I made a typo on the last figure. 2 plus 23 plus 22 plus 28 plus 27. The deviation of all these totaled up is 102. I need to divide that by 5, because I have 5 data points. So the average distance is 20.4%. What I want you to see here is when you look at Morningstar reports, if I were looking at the data in a snapshot on a Morningstar, I would look at this fund and notice that over the last 5 years, the average return was 8%, but the standard deviation was 20%. That's a very high standard deviation relative to the return you're getting. So imagine having a 20% potential up and down with only an 8% average. The risk-adjusted return is very high. And obviously, because I'm showing you this extreme, jagged example to prove a point. Ideally, you want your standard deviation to be as close to your average return as possible. You want this to be as low as possible. I guess at the end of the day, what you want is zero standard deviation with a high return. But in general, it's hard to get that. You're going to want a low standard deviation with a reasonable return, and that's how you get the best possible risk-adjusted return for your portfolio. So again, if you're analyzing the large cap value universe, and you see a fund that has 8% with a 20% standard deviation, and you see another fund that has 7% with a 9% standard deviation, yes, the 8% is higher return, but if you have to take twice the risk to get 1% more return, that's not a good risk-reward trade-off. That manager is not doing a very good job inside that fund. So you always need to look not only at the return, but what level of risk or standard deviation is being taken historically to achieve that return. We talked about beta. We talked about standard deviation. You see how the benchmark is irrelevant to the standard deviation. All you need to do is look at the fund itself and use that data to figure out standard deviation. You don't need a benchmark. So thank goodness for firms like Morningstar who do all this calculating, so you as an advisor don't have to. But now you've got a bit of an understanding about how standard deviation works. So just as a quick review to some of these first mutual fund concepts, and I've got some more for you. We talked about quartile ranking. We talked about the pie chart, looking at the underlying asset allocation so you can see what you're invested in. We talked a little bit about beta. We talked a little bit about standard deviation. I know this is a lot of detail, but it's important for you to understand how this works. There are two other key statistics that you're going to look at a lot when looking at mutual funds. You're going to look at yield and you're going to look at turnover. I'm going to talk about both of those here in just a second. If you ever get the chance to sit in on one of our investment committee meetings, or maybe even be a part of our investment committee, you're going to hear us talk about turnover and yield quite a bit in those meetings. Yield is pretty simple. By now, hopefully you've already listened to the bond portion of the training and the stock portion of the training, and you understand that bonds pay interest and stocks pay a dividend. So dividend and interest is the income your holdings will generate just to hold them. It's like owning a piece of real estate. Let's say you own a rental property. Think of the yield as the income, as the rent from that property. You own the stock, the bond, which is of course the building in this analogy, and the interest or dividend is the rent. It's the yield. It's the income generated. So let's say that a mutual fund has a yield of 3%. If an investor puts $100,000 into that particular fund, 3% of $100,000 is of course $3,000 worth of cash flow of income. So the yield is a measurement of how much income is generated from that investment. Some of your investors will reinvest that dividend or reinvest that income to buy more shares of what they're investing in. Some investors will have this income direct deposited into their checking account for supplementing income in retirement. Knowing this statistic and knowing what your client's income need is very important. Once you know what they need for income, you can seek out portfolios and seek out strategies that will give them that income. You'll often use some of our Liberty One portfolios that have a very attractive yield in conjunction with a variable annuity to set up an income stream for your clients in retirement. So that's yield. Pretty straightforward. If you haven't already seen the stock and bond portion, make sure you watch that. You'll have a better understanding of yield and dividends and where those come from. The next topic I want to talk about is turnover. Going back to my example of the BWP fund, let's say that I've got ABC stock and XYZ and DEF and 1, 2, 3. Let's say that I've got 4 different stocks in that portfolio. And let's say out there in the universe is Q, 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 and STR. So let's say there's a couple stocks out there that I'm looking at as a fund manager that I might want to put in my portfolio. And let's say there's also a couple stocks in my fund that I don't want to own anymore in the mutual fund. Well, that would mean that I might sell ABC, I might sell XYZ, so I'm removing those from the fund, and I'm going to buy these 2 funds and add those under my mutual fund umbrella. Well, if I started the year with 4 holdings and I changed 2 of them, that would mean that I had a 50% turnover for the year. So turnover is simply a measurement of how often a fund manager buys and sells, or in essence, turns over their inventory of underlying holdings inside the fund itself. Keep in mind that every time a buy and a sell happens, it creates potential capital gain exposure, capital gain tax for the shareholders. So if ABC and XYZ were sold as a gain, the gain that the fund realizes is proportionately given out to all the shareholders, depending on how big of a share you own of the fund, and then everyone pays their portion of that gain. Now, if a client owns the fund inside of an IRA, then the capital gain exposure is irrelevant because it's all tax sheltered anyway. However, if the mutual fund is owned by a trust or by a taxable account, just a joint account or individual account, then all of this capital gain is fully realized and paid every year. That tax is paid on that every year. So when working with taxable money, with trust money, you want to make sure you're using investments that are very tax efficient, that have a low turnover. That low turnover reduces the client's capital gain exposure. If you have an IRA, like I said, the turnover is kind of irrelevant, but you will hear us talk a lot about turnover of a fund in our investment committee meeting because we're trying to seek out funds that have low turnover for taxable accounts. Just depends on the situation. Lots of things to be aware of, lots of things to know and understand when it comes to mutual funds. What you've seen in this segment of your training is just some of the highlights, the things you're going to want to think about and know the most about because you're going to talk about it the most in our committee meetings, and some of these things you'll talk about with clients. But dive into the Morningstar reports. Look at all the different data points on those reports. If there's times you don't know what some of that data means, then research it, Google it, go to Investopedia. Whatever you need to do to learn those things stone cold, you'll become a better advisor, a more knowledgeable advisor because of it. You'll go into meetings with a lot more confidence, being able to answer any question a client could throw at you about mutual funds. Invest the time well beyond this video to gain better knowledge about these products and your industry as a whole.